In this video, I want to continue elaborating on the difference between process-oriented and forecast-oriented. Because even in the institutional professional world, while they will use forecasts, I will show you how they use forecasts. And it's essentially it's called scenario-based asset allocation. And here I've used simply AI to show you how this works. It can get very mathematically intense and complicated very quickly. So that's not the goal. The goal is not to overwhelm you with theory, not at all. It's just to show you the mindset behind this. Essentially, is like I said, can be very complicated and very substantial intellectual involvement in this because they have to come up with scenarios. Okay, the same way I approach, but without using a mathematical model per se, is they will use their economist to forecast the next X number of years ahead of time. They're going to look at different scenarios: inflation, depression, recession, growth without inflation, and they attribute simply probabilities. So as you can see here, a base main scenario, 50% probability, optimistic, pessimistic, stress, fat tail. So the purpose of a scenario-based allocation model is to go beyond the normalistic approach to investment, and it's to assume different kind of scenario and use historical return based on those different scenarios to literally create a asset allocation model that is as close to scientifically based or mathematically based on math, on statistics and normal variance and standard deviations of return, etc. So I'm going to move on. And what I've done is I just ask AI, give me a very basic example. For example, just using Bitcoin versus cash. And I told AI, these are my probabilities. And so let's say in the next 18 months or 2 years, I will, I will assess the probability of Bitcoin doubling from here as 10%, etc., all the way down to 90% drawdown as a 5% probability, 5% at minus 60, 10% at minus. So this is very reasonable, okay? So this is how you think. Even if you don't have the basic mathematical model to do this, this is how, when I say you have to look at both sides, this is what it is. And this is how the institutional world works, think, and applies their investment process. Okay? So by just plugging on those numbers, it arrives at a ratio of 35% to Bitcoin and 65% to cash. That's just if you want to have Bitcoin and versus cash. But then it gave me cash at 0%. So I asked it, put 4% at cash. Because see, this is how the machine thinks. This is how institutional think. If I have 1% of my portfolio in Bitcoin and we have this here, then this is the return I'm going to get. In fact, no, that would be with the allocation. With the allocation of 35, 65, I'm losing 31% instead of 90% by being completely allocated in. So this is how their fiduciary duty as asset managers, this is how they work. Now I told AI, what if cash is at 4% instead? So if cash is at 4%, now you go down to 30% Bitcoin and 70% cash because now you're earning some funds into cash. Now let's go down and add some gold and stock and bonds to that. And the answer for AI is BTC, again, still 30%, gold 60%, and cash 10%. Why? Because essentially speaking, your buffer is gold in times of crisis and cash, and BTC is your risk on asset. So you don't really need stocks if you are a hardcore Bitcoin believer, because you're going to do better with Bitcoin on a risk on bull market than just holding equities. Doesn't mean you have to do that. It's just a very quick, dirty example of how the basic asset allocation world works in the institutional world. So now by adding cash at 4% and gold in my asset allocation, then I have less exposure to gold, but I have way less downside risk. Now my risk has dropped from, what was it, 30 some percent, or 30. So we have four. See, with 4% of cash, I'm down to 24. We were down at minus 30. So the worst case scenario, Bitcoin goes to 90, drops by 90%. My portfolio is down 31%, 31.5. If I earn some return on my cash, it goes down to 24. And now if I have gold, I add gold to my composition, then my downside is reduced to 17.6% based on historical standards. Never, ever, ever an institution, any institution, larger institution, they're not run by degens, okay? They have very, very strong and stringent risk parameters they have to work with. And that scenario building is a huge component of their process. It is at the cornerstone of their asset allocation. And that is why there's no large institution in on Wall Street that will have an asset allocation of more than 10% to gold, or more than 10%. Even 10% would be huge at this stage of an improving asset for an institution to recommend to its other institutional customers, client that they're managing hundreds of millions, a pension fund, endowment fund, etc., to allocate more than 10% to Bitcoin. That would be irresponsible, mathematically irresponsible. So the maximum they will start with is 5%. So in my opinion, I mean, Bitcoin will never, gold, after centuries, most portfolio manager will not allocate more than 5 and more than 10%, and even most probably not more than 5% in their portfolio to gold. Despite its long-term historical survivorship, proven track record, because gold also goes into deep protracted down cycle. When it works superbly well, but when it doesn't, it's a drag on return. So the allocation of gold in most institutional portfolio is always very light. In my opinion, Bitcoin will suffer the same thing for a very long time, if not forever. It is not considered in the institutional world as a very special thing like all the maxis and degen think it is. So my goal with all this is also to try to help you reframe your enthusiasm. It's more your blindfolded enthusiasm to what crypto, or especially crypto, but even Bitcoin is. Because the older Bitcoin is, the less and less and less we're going to see those parabolic move. We will, on risk on period, we will keep seeing better returns than stocks, but those 1000% are off the table. It is going to continue to be an asset that is linked to how the Nasdaq is doing. It's just going to keep most probably doing better than the Nasdaq. But if the Nasdaq is risk off, Bitcoin is risk off. Period. That's it. I mean, you've seen clearly that Bitcoin is not digital gold. Bitcoin is Bitcoin. It's a risk on, risk off asset. Period. That's it. There's nothing more to it. On an institutional level, on a rational investor level, it's just another asset. You wanted adoption? That's the cost of adoption. There's nothing is free in the world. Nothing. Everything comes with a certain cost. So the underlying mindset of a model like this, as you can see, well, if you can read between the line, it's they assume and understand that they cannot predict the future with 100% accuracy. So they lay out all the possibilities and assess a probability to it. So for example, let's take just Bitcoin again. Let's say in the next 18 months, Bitcoin drops 50%. So in 18 months from now, you're going to redo your scenario and you're going to apply different probabilities, because now your probability of gaining 20%, 30%, 60%, 100% are much higher because you've already dropped 50, 60%. So now your bottom is less heavy. Your top probabilities will weight more, and then you're going to allocate. You can redo the scenario, and now the machine might tell you, well, you need to be 45, 50% Bitcoin and 45, 50% cash. But after a 3-year bull market, if you keep pushing the upper boundaries, then you're just playing with fire. You have to allow for more downside. So that alone, if you were holding Bitcoin, cash, and gold only, this is the type of return you would expect if Bitcoin drops by what was this? No, it doesn't matter. That's the middle ground, so it's probably like the 30%. While you don't have the obligation and the fiduciary duty of a large institutional house, you can still use the mindset and the proper guidance that this type of model gives you. So if you can read between the line and understand exactly what that process is, it's not forecasting. It's using probabilities of outcome and applying historical benchmark to those outcomes. So they've essentially removed as much as possible the human bias component to it and apply a rigorous, mathematically not perfect, but proven model to get the emotion out of the process. Okay, I think that's enough. I mean, I just wanted to expose you to the process, the professional process. There's no point making this heavier than it needs to be. Okay.